Well, hello, everyone, and welcome to another fantastic webinar brought to you by Alpine Brokerage. My name is Dan Charlie, and I'll be your host today. Let's dive right in. Today's episode is called Long-Term Care, the Formula for Success. We're going to have three special guests today to talk about their unique proposition to solving the long-term care question for your clients. But before we get started, I wanted to say that I was thinking about today's episode, and it just so happened when I was thinking about it, the movie Ford versus Ferrari was on. And as I laid out today's show, I started making comparisons with the movie. Now, for those of you that haven't seen Ford versus Ferrari, I encourage you to watch it. It tells the story of Carroll Shelby, who's played by Matt Damon, and his bid to win the 1966 24-hour Le Mans in a Ford. Now, the Le Mans is a 24-hour race. It's held in France. And typically during 1966 and from 1962 to 1966, it was dominated by Ferrari. Now, Ferrari was known not to make the most vehicles in the world like Ford, but they were to make the best vehicles in the world. And they only made a very few of them every year, and they were all handmade, but they were the fastest and the best. As I said, they won 4 out of the last 5 races in 1966. So to set the stage for today's meeting, I thought I'd grab a clip that I really liked from the movie of Carroll Shelby convincing Henry Ford II that they should use the new prototype of the Ford car, the GT40, and have the gentleman named Ken Miles drive it. Now, let me tell you, I personally think that this scene demonstrates the sales process for long-term care insurance to a T. And we here at Alpine are going to help you make that conversation with your clients about this topic just as exciting as the video that you're about to see. So let's kick it off with the video.
Open the door.
Sorry, sir. If you just give me a moment.
Open the door.
You ready? The name on the middle of that steering wheel should tell you that I was born ready, Shelby. Hit it.
Attaboy.
Got a little kick. Come here. Go.
Open the door.
There we go.
Good God, Mr. Levy. Okay, sir?
Oh, my God. Oh, my God. Oh, my God.
Now, this is one of my favorite parts in the movie altogether.
It's about right now the uninitiated have a tendency to soil themselves.
All right. Well, we're here to provide long-term care solutions to make grown men cry. So with that, I'd like to kick it off with our first guest, Kevin Fisher. He's the regional sales director with One America. Kevin, I like to call, he's the Enzo Ferrari of the long-term care insurance business. And why do I say that is because One America has some of the most innovative and forward-thinking solutions to long-term care in our industry. So with that, I'd like to bring Kevin on. Kevin, are you there?
I certainly am. How are you doing this morning?
I'm doing great, Kevin. Thanks for joining us today. So
It's funny that I'm never, ever compared to a Ferrari, ever. I'm more like the Edsel Ford,
yeah. Well, it's such an interesting movie because, Ford was known by making millions and millions of cars every single year, and Ferrari made very few. And basically what happened, if you've seen the movie, is that Ford wanted to purchase Ferrari, and they used that to leverage up a partnership between Ferrari and Fiat. So they used Ford as a pawn and insulted him. And so he set out to go with Carroll Shelby and actually build a race car that is going to, beat the Ferrari competition in the Le Mans. So it's a great story. I love Matt Damon's character. I also like Ken Miles, the driver. So it's just a great movie altogether. But glad to have you on today, and wanted to give you the opportunity to talk about One America's product solutions and what they are available to our clients out there. So take it away.
Oh, thank you. And we do have a boatload, so I'm going to hit highlights. If you want anything in depth in terms of information, if you think of a question, if you want to know more about products, please contact Dan's team at Alpine Brokerage. They can get you down the road. Of course, you can always reach out to me. You can call me, email me. If you scan the QR, that'll just give you my business card and pop it into your iPhone or Android. But anyway, thanks for having me. We're going to really focus on one of the three ways to pay for long-term care. Now, remember, the important thing for this conversation is we're talking about funding a long-term care strategy. And the plan and the funding have to work together. And funding is not necessarily a plan. Before you even get down the road of plopping a product into place, you got to have some sort of idea of what you want to do, you being the client, you being the advisor, with the financial plan and the resources and the family dynamic inside of that. While we can't control that, we can influence and help make things more effective inside of the family by providing funding. So we're focusing purely on the funding component, and there are only three ways to work toward paying for a long-term care, extended health care scenario. The first one really is our default plan, and that's taxpayer assistance. Most of these strategies here that involve taxpayer assistance are focused toward Medicaid and repositioning assets. That's something we don't do. That's frankly not even in a market where we want to be. When you're playing that taxpayer game, that requires you, being the individual, to spend down your monies in order to qualify. So if you have too much money, too much assets, too much income, you're not going to play into that game. Which really leads us to the actual default program, which is self-funding. Sadly, most people elect through default or decision to self-fund. And that's about 85% of the population in the United States. Their strategy is, we'll deal with it when it comes. And how do we pay for it? Well, it's going to come out of my pocket. Out of my pocket at the time of the need. There's no planning involved. It's purely reactive. There's no proactive strategy in place. This is the most expensive because if you opt for paying out of pocket, ultimately, if the situation deteriorates to such an extent that you exhaust everything, you now become situation number one, which is utilizing the resources provided through Medicaid or Title 19 or whatever state program you have in place. What we're going to focus on today, all of us, is option number three, which is leveraging through long-term care insurance or insurance-based strategies. Simply, we maximize the leverage of the dollar, the same story we've had forever about pennies on the dollar, paying for that care, paying for that benefit. We're transferring the risk from the insured to the insurance carrier, and it's going to be a pretty simple solution in that it's premium to benefit, and there's a pure and direct correlation. Now, I'm going to focus on what we at One America do, but more specifically, let's look at how really all of our products in the industry work. And it says asset-based long-term care, but this is applicable for any long-term care solution, be it a traditional product from Mutual of Omaha, you'll hear from John Gibbons, or from a chronic illness, critical illness, terminal illness type of scenario. It's still effectively the same thing. And what we're doing is taking the assets, these income-producing assets in this portfolio, and repositioning a portion into a defensive strategy. And simply, we're earmarking that bucket for long-term care. You're just saying, this is where I'm going to go for those resources. It's nothing more than that. But through the beauty of insurance and planning, we can turn that chunk that you've allocated for your defensive posture into a benefit. And at One America, we can do an unlimited lifetime pool that can protect more than just that amount you've allocated. You can protect all of those income producing assets in that portfolio, depending upon how that strategy works out. Now, first thing I want you to remember, we at One America are the only carrier that offers lifetime asset-based long-term care products. Only carrier. Those products come on two chassis. One is a life insurance policy, and the other is a deferred annuity chassis. And our funding options are across the board. We can do a lot of different stuff. We can pay premiums lump sum via cash or 1035 exchange, lump sum from a qualified plan into our turnkey strategy. We can do recurring premiums. We can do combinations thereof. We can transfer via 1035 existing non-qualified deferred annuities into leveraged up asset-based long-term care with our annuity care product. So we got a lot of stuff that we can do. Just understand this. From a funding perspective, funding being premiums perspective, if you have monies and you know what you want to work with in terms of premium dollars and where it's coming from, in all likelihood, we can help you find a strategy. And that's where you want to pick up the phone if you get confused. Talk to someone at Alpine. Worst case scenario, you have to come direct to me or my internal Justin, and we'll help you find a solution that aligns most directly with what you need. Now, that being said, what you see in front of you is a highlight of lifetime benefits. Everybody can do short duration, including us. Here's another differentiator for you with One America. We're the only carrier on the asset-based side that can provide true joint coverage. One policy, two people, husband and wife. As long as they're insurable and within 25 years of each other, we can get them on one policy. And that policy design can be limited in duration, or it can be unlimited lifetime in duration. We see most of our policies on that joint basis in that lifetime model. Let's get into an example for you. Let's talk about funding using savings. This is typically a single premium situation. It can also be applicable for a 1035 exchange. Now remember, with 1035 exchanges, those rules are applicable regardless of where they apply, be it life insurance, annuities, or long-term care. It must be a like-to-like exchange. So an individual life to an individual life, a survivorship to a joint policy, and we can do life to an annuity, annuity to an annuity, but you can never go annuity to life. So remember, 1035 exchanges are a viable funding option in this scenario. Now, a couple of things I want to point out here. At One America, we will work up to the age of 80. Why 80? Because that's where our actuaries like us playing. We can play up there. Typically, our clients have been in the middle 60s, but the industry has trended toward a younger end. That being said, I'm going to show you a couple of examples for clients who are age 60. This is not our sweet spot, but we are very competitive here. Now, in this case, we're going to look at a single premium, and we're going to purchase long-term care benefits using Asset Care. Asset Care is our flagship product. It's been around 30-odd years. This is what got the whole industry started. So for 30 years, we've offered our asset-based long-term care in Asset Care, which is a whole life policy, guaranteed premiums, guaranteed benefits. And in this case, we're going to single premium fund the whole thing. And what that buys us simply is a base policy. That base policy, that $124,000 is our death benefit. You'll see that there's not a ton of upside leverage from a life insurance perspective. But look, we're not selling life insurance. We're selling long-term care with a secondary benefit being life insurance, that death benefit, if it's never utilized, it being the long-term care benefits. Now, remember, in this scenario, we are looking for something for a couple. And as I mentioned earlier, we sell most of our policies on a joint basis with lifetime benefits. So we guarantee we're going to pay at least $124,000 and change out if we never utilize the policy. If we need it for long-term care, we can extend for infinity until that client is no longer on claim. Now remember, here's something that's important about long-term care policies. Those claims do not need to be permanent. It may be a recoverable situation, a broken hip, a stroke. Those two maladies and injuries alone, you can recover from them, but they would qualify if the client is ADL deficient for long-term care. So what will this $100,000 buy? Well, it'll buy $44,000 and change per person of lifetime benefits. Now remember, if we wanted a fatter pot, we can lop off and do shorter duration, but we're looking at longevity here. Just tuck this in the back of your mind. I'm showing you level benefits. We can include inflation of 3 or 5% compound on the whole contract, or just on that continuation of benefit rider on the right side there. Some people are saying, okay, Fisher, that's not a big deal. But let me show you something else here. In order for that $100,000 to generate day one, $44,000 per year going on for infinity, you need a return of over 40% to generate that starting day one if we're to go on claim the day the policy is issued. And for a couple, obviously, it's going to be greater than that. But keep this in mind for a second. And remember, we're going to look at a strategy that's not just single premium. With everything going on in the world, we've found that recurring premium, annual premium strategies have come into play. We're going to look at the same couple age 60. And what we're going to do is fund the premium on a pay all years situation, paying from now until age 95. The situation is pretty simple. You write the premium, you pay for the policy, and the benefits are available. What this will provide is something similar to what you saw earlier. Now, here's a couple of things I want to point out. This is a joint policy. That first portion, that $3,000 that you see on the left, is insurance. That's life insurance premium. That $2,869 you see on the right is long-term care insurance premium. That can be a deductible premium for a business or an individual, or it could be funded using a health savings account. Now, the advantages to these, please grab the phone, call Alpine and ask them to work with you on a recurring premium basis and explain how you can pay for that COB with tax benefits and receive those benefits from a premium paying perspective. We'll make sure we have a conversation with you and in partnership. But understand this, that continuation of benefit rider may be deductible as an individual or as a company. It all depends on, one, corporate-wise, how that's structured, but two, whether or not the client itemizes and hits his adjusted gross income level relative to medical expenses. Long and short of this thing is $5,900, and here's the highlight of recurring premium. Guaranteed premium. This premium will not change ever. So what you see is what you get. If you're planning for long-term care, if you're planning for a long-term window for income strategy, here's a way to stabilize that so you take one variable out of the equation. If you're planning that income distribution strategy, we know we're going to pay $6,000 a year for our long-term care premium. But there's one other thing inside of this that I want to point out. When the client goes on claim, premiums will be waived. If it's a joint policy, first client goes on claim, premiums are waived for both of them until that claim ends. So if he goes on claim, his claim starts in year 3 and lasts to year 5, and his wife's claim starts in year 5 and lasts until she passes, they don't pay any premiums during that claim period. And we don't recover them because it is a true waiver of premium, waiving all premiums for the policy. Let's look at another example. And this is really the flagship thing. And I want you to tuck this in the back of your mind. If you're using qualified money, if you have clients with qualified money, here is the only turnkey strategy to get to an asset care policy, not for just the IRA holder, but for the IRA holder and their spouse. So here's our strategy. Let's assume we have an IRA. We will work with a couple that's nearing RMDs, and it's her money. Why the heck not? So in this case, they're a little older. The current IRA has $200,000. And what we're going to do is an IRA rollover. So it'll be a trustee to trustee transfer into One America. Once we receive that IRA money, we'll pour that into a fixed deferred annuity, then bonus that money 20%. So we now have a pool of $240,000. So we instantly grow our IRA to $240,000. This is all setting up for our funding of asset care. Over a period of 10 years, what we're going to do is take a distribution of $24,000. This will be a taxable event, constructive receipt, and then pour it into our asset care policy. In this case, you see it as a lifetime benefit. But we can make that short duration, long being lifetime, however it fits for your client. Effectively, what we're doing, and the way I like to think of it in my simple mind, is we're using IRA Max to leverage into a long-term care policy. Our long-term care policy being asset care. In some way, shape, or form, your client will receive tax-free long-term care benefits when they need it. It can start the first day of the policy. It can start 10 years into the policy. Whenever they need it, that money will be available to them. And again, just like with our out-of-pocket funding scenario or our lump sum, those monies are available $57,000 per person. Question a lot of people ask is, what if we're on claim at the same time? Hey, you both have equal access to that pool of money up to that maximum amount. And remember, in this scenario, we can add inflation for both the base portion of the policy and that continuation of benefit rider so that we can have that growing over a period of time. This is just one option for using qualified money, but it's the most effective option simply because using our distribution, those monies, that $24,000, can count toward required minimum distributions from an IRA.
Hey, Kevin, it's Dan.
Yes.
Just wanted to jump back in here and ask a quick question for you on this, because I think this is one of the most unique things that One America does. So we all know how many thousands of dollars, millions, trillions of dollars that are sitting in qualified accounts right now. And as your clients are approaching that RMD age, they're thinking about their distributions, and they could have already, but most of them are now starting to think about how they can leverage up some of those dollars for their care. And this is an unbelievable way for them to get the additional benefit. I kind of, talk about left pocket, right pocket. Your clients have this money in their left pocket in their IRA. If they go on claim, they're probably going to tap into that, because if these are the type of clients that we most know, a lot of their money is sitting in qualified accounts. They usually have a large qualified account, and then they have some non-qualified funds, and then they have their typical real estate assets and some of the other things that a normal person would have. So being able to leverage that pocket and put it in the other pocket and still have that money there that's in the annuity option, but it's being leveraged so that they're getting these long-term care benefits is a repositioning that gets the client to have their dollars work harder. And I really think that that's a great piece of the One America portfolio. And correct me if I'm wrong, you guys will administer that entire thing. Is that correct?
Correct.
Yeah. And then at the end of the day, the client just gets their 1099 for their quote unquote RMD that they would normally get anyway, that they expect. And so everything kind of works out. That's my understanding of it.
Correct. And the one, you can approach this using a couple of other strategies. One would be, put in a SPIA, but if you use a SPIA, those distributions generally don't count toward RMDs. or you can self-manage it, but you don't get this bonus. This is just one way to utilize qualified money. But I'm trying to impress upon everyone, this is one option. It may not be the right option for your client, but we have so many others available. We have to start somewhere, and we can pivot and find the best solution for that. That's what makes One America great.
Great. Well,
ability.
I just wanted to jump in on that one thing, and go ahead and apologize for popping in there on that.
Oh, not a problem. I wanted to rip through this so I can get into the next setup. But the one thing that makes One America great is that we can build a strategy specifically for your client. It's not a cookie cutter solution.
It's not a product, it's a strategy.
Exactly.
Great.
Using an existing annuity, this is going to be strikingly similar to the single premium. All we're doing is a 1035 exchange from an existing annuity. Could be fixed, could be variable, could be an index product. We do a rollover into our annuity care product, which can either be on a fixed chassis or fixed index chassis. More information on that, give Alpine a call. But the long and the short of it is I can turn $100,000 into an unlimited lifetime stream of tax-free money for long-term care. Couple of things from an underwriting perspective. Take a look at this screen. These are maladies that we will consider. And I hope something jumps out at you. Bipolar disorder, stroke, narcotic pain medication, kidney transplant or failure, coronary heart disease. All of these are generally auto declines. We are willing to work within that. And let me share this with you from an underwriting perspective. Everyone can play inside of the table 4 or better box. We're willing to look at the sum of the parts because all maladies are not the same. Diabetes is an example. It can go anywhere from a decline to a preferred rating. It all depends. And we're willing to take that step forward and step through the process and look at your client. If we're not going to be able to get in that table shave, we're going to do full underwriting, which will certainly include a paramed exam and definitely APSs. The paramed typically is for large net amounts at risk. That being said, we want your business and we're willing to work for it from an underwriting perspective. In my opinion, the best client piece that has ever been produced is this one here, our step-by-step guide to receiving long-term care. If you do want to see this in hard copy, please let us know. We'll get it to you, but it's a great point of sale piece. It may have One America on it, but it's company neutral and product neutral. It talks all about the one important thing with long-term care, and that's planning. You've got to have a plan in place before you fund it. So let's have that conversation either in conjunction with a policy delivery, preferably before we put a policy in place, but somewhere along the line, and at a minimum, utilize this. It's free to you. Just let me know when you got it. You want to know more about One America? Feel free to scan that or go to oneamerica.com. About us, it'll tell you everything we got. Long and the short of this thing is, thank you for your time. If you do have questions, I'm more than willing to answer them at any point in time. We want to earn your business. We want to provide the best solutions to you and understand that if we can't do the job, we will help you assess the scenario and try to find the most effective solution for you. We want to earn your business, and I thank you for your time.
Awesome.
Sam, I'm going to throw it back to you because
that's it. That's it. The Enzo Ferrari of long-term care, Kevin Fisher. Thank you, Kevin. Appreciate your time today. Very good information on the One America product portfolio and really where it fits. So now that we've had Enzo Ferrari on, now I have to start to introduce our next guest, which is who I like to call the Carroll Shelby of long-term care insurance. And his name is John Gibbons. John is the LTCi director at Mutual of Omaha. And, listen, Carroll Shelby, he was an every man's man. And in John's product lineup has some unique applications, both for the middle market as well as for the business owner market. Although, he wasn't Enzo Ferrari, Carroll Shelby was a guy who, came from nothing, actually won the Le Mans, and then couldn't race anymore, and then he decided to start building race cars, and so he was a solid competitor and a real winner in his own right. So I'd like to introduce John. John, how are you today? Thanks for joining us.
I'm doing great. Glad to be here. Appreciate the opportunity. Hope the lighting's okay. I'm in a hotel room.
You look marvelous. You look marvelous. So
excited to be here.
Really appreciate you jumping on with us. I know you are traveling, so thank you for dialing in. I could say your backdrop looks great, though. It's like it was designed just for you to do this presentation. So we're going to talk today, and your presentation is really going to be about the Mutual of Omaha portfolio, traditional LTC, the LTC marketplace as you see it, and where you think the Mutual of Omaha fits. Because traditional LTC got a little bit of a bad rap for a while, John. It's got a little bit of a stigma to it because clients don't like two things traditionally. One, the fact that they can't get their money back if they don't use it, and two, the premiums could go up. But all that being said, I think the comment is, it's better to have something than have nothing. And so in today's day and age, these products fit a certain demographic of people, and that's really part of the fact find discussion that you need to have with your clients. Do they have a lot of assets and they're looking to use those assets to leverage their monies to create long-term care? And that would be maybe more of a One America type product. Or are they a person that has a steady income stream? Maybe they have a pension. Maybe they're a corporation that wants to provide some benefits for their employees, and then that is more of someone that would fit the model of what I would see as the Mutual of Omaha type portfolio, where you can give them a low cost option. They can get some good benefits that at least protect them. It could be partnership certified, depending on where their state is. And they could take advantage, maybe, John, of some government, I would say nudging in order to them to purchase some of these policies and be self-insured. So I'm really bullish on the Mutual of Omaha portfolio and traditional LTC. I think as we go forward over the next couple of years, we're going to see an increase of people going back to those types of products. And I'm just happy to have you and looking forward to this presentation. So with that, I'd like to hand it over to you and we can get started.
Great. Hey, one quick question. Refresh my memory. Do I have 20 minutes or 30 minutes?
You have 20.
That's what I thought. Okay. Awesome. Thank you, everybody. Glad to be here. As he mentioned, there has been kind of a shift back. The asset-based products are great. Great companies, great products. I actually call them the Ferrari. And it's good to have an alternative because sometimes not everybody's willing to pay for that Ferrari, even if they can afford it. Look at it. Hey, great options, great companies, but maybe I don't want to spend that much. And then here's a good alternative. Our sales have been way up for the last couple of years because of that. So if we could pull the slides up, I don't see the slides.
Yeah, John, you're going to, when your presentation shows, you're just going to see that presentation and then you're going to go ahead and just move forward with that and let me know if that's a problem.
My fault. I didn't do that when I was in the.
Share that full screen and you'll be ready to go. I'm sure you could do this without the slides, John.
I probably could. But
funny.
Hold on. I apologize. My fault. We practice this, and this is my fault.
It's pretty good. Pretty good opportunity. So,
can you see the slide now? Got to hit share my screen.
Yeah. You should be good. It should pop up, and I'm going to go away.
Okay. Now do you see it? Do you see my screen?
I do not.
Not sure why I hit share screen. Oh, I got to hit it again. Got it. Now
Well,
you
you
should.
know what? While we're pausing for technical difficulties, maybe I could.
You
Oh,
have it now?
here we go. Here we
Okay.
go. There we go.
All right.
Big
Here
shout
we
out
go.
to Tim in the control room for getting that to happen. Thank you, Tim, over in the control room. He caught the pass in the end zone to make the catch. So appreciate that. But John, I'm going to hand it off to you. We're rocking and rolling and looking forward to this presentation. So let her rip.
Yeah. Okay. A lot of this I'm going to go towards sales ideas more so than a product. I'll touch on some of that, but just keep in mind nationally, you can see down in the right-hand corner here, $104,000 a year for long-term care. Now, the average person that buys this is around age 55, 56. The average claimant, and you may want to write this down, is age 79 or 80. So I buy this now while I'm young and healthy, and it's less expensive, but I may not use it for 25 years. So we have a calculator you can use, and you can go into our spot, or Genworth has a good one also, and I can put in here, pick my state, and pick out 25 years, and it's going to show me, we project it's going to be $224,000 for care 25 years from now. So Mr. and Mrs. Jones, the average life expectancy of somebody with Alzheimer's is 9 years. So that means half of them are longer than that. So let's say, Mr. Jones, you have a 10-year event at $200 and some thousand a year. You're over a $2 million extended care event. What's that going to do to your portfolio? Is that going to wipe it out? Is that going to put a lot of damage? And then they're looking at it and go, Mrs. Jones, what are you going to live off of? So to me, there's a good way to position that. Not so much the cost is today, what the cost is in the future. All right, sales ideas. Think about RMD money. I think Kevin just mentioned something about that on his. So a lot of people, when they hit 72, they don't want to take the income out. Some of them don't need it, and they do it kicking and screaming. Well, here's an opportunity. Take that money and buy a policy for yourself or yourself and your spouse and put that money to use. Another one here is called stacking policies. So we're finding a lot of people are buying this in their 40s now. There's a trend. I think what agents are doing and advisors are saying, let's buy this in your 40s. Let's get a small policy while you're young and it's very inexpensive. And then when you hit 50, 55-ish, let's stack a second policy on there. But we're locking something in while you're younger, you're healthy, and it's very inexpensive. And then when you hit age 60, we can look again and see if you need a third policy. Another option is you combined our product with asset-based. And then you're going to use our product first, buy a small policy there, use ours first. And then if you need more care, you have it with the asset base. If you don't, you have your death benefit. So you can stack policies both ways. You need to let your client know when you're talking about extended care planning, in retirement, you're going to hit 4 bear markets. All right. And now we're in one right now. And I guarantee agents are talking to people and just say, hey, now's not a good time. I just lost 200,000, 400,000 in the market. Well, guess what? You just had an extended care claim. That's exactly what happens. And you're freaking out over this 200, 400. What do you think is going to happen when you have that year over year over year if you have dementia, MS, Parkinson's or something? So Mr. and Mrs. Jones, you're pulling money out of your portfolio. And let's say it's that magic number 4% or whatever. Then you're in a bear market like now. And then you have an event that's $200 and some thousand a year. What's that going to do to your portfolio? So timing on that positioning is perfect. Assumptive close. That's something I just tell advisors when you're going through this, think about the fact that don't ask for an objection. If you're getting people and you're walking through this and you're nodding their heads all the way through it, when you set the stage, then you walk through the illustration, you show the premium, and they're nodding their heads agreement, just start writing the app. Don't ask for an objection. I did that in my early days when I was with Genworth, and I had to do a lot of assisted sales. I partnered with the wirehouse money managers, had a smaller territory, did a lot of assisted sales, and 70% of the time I did that, they'd let me keep writing. Another one is top advisors I've found in the industry will sometimes use the software and create the illustration with the client. So they'll pull it up and kind of guide them, but then let them know the different triggers and pull and things, and watch the premium adjust. And if they created it, they own it. They bought it. All right. I think that's a great idea. All right. Next, wealthier clients. Wealthier clients will do this. All right. Wealthier clients, not all, but many of them get the concept of other people's money, transferring the risk, pennies on the dollar. I think one agent I used to work with sold the former CEO of McDonald's, obviously very wealthy. Why'd you buy this? Too good of a deal not to, right? Had another one this year. I think the person had a $50 million net worth. They asked him why he buy it. So because I think my kids are going to be more concerned about the money than me if I got ill. Fair statement, right? So here's a big one in the middle here called loss of step up in estate planning. So what that means is if I'm 60 years old, I buy a stock today at $10. And then now I'm age 80 and that stock's worth $100. And I'm wealthy. And I go through my liquid money. Maybe I have $500,000 liquid. I go through that. And now I have dementia, MS, Parkinson's, whatever. It's a long claim. Now I have to liquidate something. I liquidate that stock. I got to pay taxes on there, right? If I need $200,000, I got to pull out $300,000. But the bigger deal is because I didn't have a policy to pay for this, I have to use my own money. I just lost the step up in that stock that I could have given to my adult children at the $100. No tax ramifications. So I have some advisors say, hey, I bring this to all my wealthy clients for one reason, it's this loss of step up. Now, I will say, keep an eye on this, though, because this is something Biden wanted to go after. Now, it doesn't mean if a different regime came in, they wouldn't put it back in, but just keep an eye on that. Another big thing is...
Hey, John, I just want to stop you there because we do have some people listening, and I was getting some comments on this. So what you're saying in that is that if I have a stock portfolio and I'm a financial advisor, and maybe I'm managing that money or working with that client and they have it invested in traditional mutual funds and those types of things, if they have to liquidate it for long-term care, they're selling those stock positions off to pay for that care. And they may have owned that stock, since the 80s or the 90s, and they may have a huge basis in there in which they're going to be taxed. That if they were to pass that on to the heirs, given today's tax, laws, they would receive a step up in basis on that, which is a huge gain that they would normally give to their children with no tax. Whereas now they're liquidating it to pay for coverage. So by purchasing one of these policies, you're accessing the policy for that money and not that stock portfolio. And by the way, hey, not to take away what's in it for the advisor, that's protecting their assets, their AUM that they have under management, and giving them an opportunity to have a longer tail, to have conversations with the children of their clients to maybe hold on to some of those funds after that person passes away. So I was getting some questions on that. I wanted to hop in because I think that's a great topic for the wealthy clients, and showing that this is a solution for those individuals as well. So I'm going to pop out, but thank you for that.
Yeah, absolutely. One last comment on that. Just because somebody's wealthy, I found, doesn't mean blow it up as far as covers, like make it very, very robust. There's a tipping point for them on what they'll spend. They'll look at it and go, if you hit a certain point, I'm just going to self-insure. Matter of fact, so I would possibly, if I was you, I'd maybe show a very robust and an average one. And that's what I used to do and let them pick it. But there's a tipping point where they'll go, I'm not going to pay that much. I'll self-insure. Here's a good one you can use. Just draw it up on a piece of paper. You're talking to a prospect or a client. On the left-hand side, retirement A. I've got $100,000 coming in retirement. If you looked at the cost of care I showed in the first slide, for home care, it's $51,000. I'm getting care at home, cost of $51,000. My income is now $49,000. But retirement B, this person bought a Mutual of Omaha, $7,000 monthly benefit. Now their income is $184,000 if I need care. Mr. and Mrs. Jones, which would you rather be, retirement A or retirement B that had this covered? It's just a simple way to draw it out. All right, we have something built into our product that's really slick, and nobody else has this. If I have to, when you talk to 55-year-olds, the objection a lot of times is the I got kids in college. So I got kids in college. I'm 55 years old. Mr. Jones, we're going to put you at 1% inflation. I have to put something on here. You said the first kid comes out of college in 3 years. I can up on policy anniversary my coverage. Now I'll add it to make it 2.5%. Said the second one, last one comes out in 6 years. Well, now I can up it again. You have more disposable income to 3%. So I can up this for the first 20 years or to age 75. I can always go down. The other thing is if I have a stroke at age 70, I can up this to 5% if I want, even if I'm unhealthy. So this is a huge deal of flexibility of adjusting your inflation and your premiums down the road. In spirit of time, I'm just going to touch on, we have partnership in here. There is value in protecting assets for blue collar and upper middle class people. We have tax favorability. If I'm a C Corp, 100% write-off, me and my spouse. If it's a pass-through, LLC, that's not a C Corp, S Corp, partnerships, whatever, it's tiered by my age. So in this bracket, if I'm 51 to 60, it's $1,690 for me, $1,690 for my spouse. If she's in the same age bracket, that's what 60 was $3,380. I can write off of this premium. This is missed by agents. Business owners love running things through their business. Please take advantage of that.
Yeah, John, let me just pop in because we do have a couple more minutes, and no problem if we run a little bit over because we had some technical difficulties. But I do want to talk about the business owners because we do have a lot of people on the webinar today, the stream, that are working with business owners. It's a big need, I think, in our country today, because there's so many people that are starting small businesses out there. So if we could just go back to that slide and talk about that business owner eligible on premium. So if they have a C Corp, that's 100% write-off. So can you just spend just a minute going through that one more time so all of our listeners out there make sure they get that piece, because I think it's very important.
Yeah. So if I'm an owner in a C Corp, I want to buy this product, our traditional long-term care. Okay. These are tax qualified plans. Doesn't always work with asset-based, but there are a couple out there. One American will be one of them. The rider, you can write off at the base.
The charge on the rider.
Yep. So C Corp, my premiums are $10,000 a year. I can write off $10,000 a year for me and my spouse. And my benefits are still tax-free, unlike disability insurance where you'd be taxed on that. The business.
So what you're saying is untaxed dollars go to pay the premium and tax-free dollars come out of the policy. I just want to make sure I understand that correctly.
That is correct.
Okay.
Yep.
Sounds good. Tell me about the pass-throughs now.
Now I have everything else. I'm a sole proprietor. I'm selling widgets on eBay or something.
Right.
I'm a business owner. An S Corp.
You look more like a hot dog cart guy to me. I don't know, John. Dogs on the corner.
There you go. Yeah. Lemonade stand. So you have the ability to write off the premiums based on your age. So again, I'm in this bracket here. You're going to find a lot of business owners between the age 51 and 60.
Yeah.
So for me, that's the 1690 here.
Uh-huh.
You can see I'm a business owner and I'm still working at 61, 65, 66. I read 4,500 of that premium.
Uh-huh.
And my spouse. My spouse doesn't have to work for the business at all.
Right.
Same thing, it would fall into my spouse's bracket.
Mm-hmm.
So as I said, with the 51 to 60, I can write off like $3,380 of that premium. If I'm like 65, I'm writing off like $9,000 of my premium.
Yeah. Awesome. That's unbelievable. And I would just quick plug for Alpine Brokerage. If you want to talk about these strategies more, especially the tax implications and how it may affect your business owners and what businesses they have, give us a call at Alpine Brokerage at 866-777-2006. Talk with your specified wholesaler on this, and they can get you in touch and make sure that you're talking to your client's tax professional as well, so that we're all on the up and up there, because we're not giving tax advice, although we know that they can save on these with these premiums. So I thought that was great, John. Thank you. Let's keep going and finish it out strong for you. Thanks.
Okay. I have some key phrases. I'm not going to go through them in spirit of time. If you need me, reach out to Dan and his team. And if any of you are new to Alpine, you've got great opportunity here with Dan and his team, and please reach out and utilize them. One thing I want to hit, we have return of premium. If I'm age 64 and below, I can have return of premium on here. All right. So we know the concept that if I don't use it, I get my money back or whatever. Now, keep in mind, our big thing is we're less expensive than the alternative with the asset-based. All right. So, the asset-based, great companies, great products, we can be a less expensive alternative. But we do have return of premium, age 64 and below, that you can utilize in that, if that need. All right, and I'm going to be less expensive with return of premium than asset-based. Now, fairness to them, they're going to have guaranteed premiums. I won't. But our products today are priced differently than they were 30 years ago. And if there was a rate action, it shouldn't be as significant as the past. The big thing on here, the last thing in the bottom, we can make our product look like indemnity. So if I'm using my benefit and I want to use a neighbor or a friend as a caregiver, if they get a certification, which means I go to night school for a week and I get certified, I know how to be a caregiver, you can pay them cash with our product. That's a huge deal. It just cannot be a family member. All right, cannot be a family member. All right, spare the time. We have some good marketing pieces. I'm going to leave it at that. Here's my last thing I'll say. Here's your call to action. You're all investing an hour and a half or whatever on here. Make sure you're proactive. Go look at your book of business, 50 to 65, those clients, okay? And target them. Look at single females, especially like in their 60s and 70s. They're concerned about this. They don't know they can buy it if they're healthy. All right, we talked about the business owners and, again, proactive with your wealthier clients. And with that, I'll throw it back to you, Dan. I appreciate the opportunity.
Oh, thank you so much, John. Appreciate you jumping in here while you're traveling and giving us some quick pointers on the traditional LTC marketplace, where Mutual of Omaha fits, because like I said, I do think that there is some need for this. And obviously you guys have seen the sales jump up here. And I think you hit on a couple key opportunities for people. So thank you very much. I appreciate your time today. All right, folks, we're going to close it out. We're going to close it out strong. I know some of you on this call may have been asking, well, Dan, this all sounds wonderful, but there's one, 800-pound gorilla in the room. It's called underwriting. And a lot of clients may or may not want to go through underwriting, and they may or may not qualify for underwriting. Now, I know One America and Mutual of Omaha, they're going to do their best to get all of your clients through underwriting, but we know there are certain situations where the client maybe doesn't want to, or they're just not going to qualify. So our next guest is going to talk a little bit about how their products fit that mold. And I would tell you, shortly after the pandemic, Alpine started looking at all of the riders that were available on indexed annuity products and separating them between those that require confinement and those that do not. Because what we found is clients at that time and now going forward are not interested in confinement for all the reasons we all know. So what are the opportunities out there for clients that can qualify for an increase in their maybe income payments on their income annuity and not have to be confined to use that? So quickly, the F&G products started rising to the top. So today here with F&G Life and Annuities is Garrett Evans. Garrett, are you there?
I'm here, Dan. Thank you.
Hey, Garrett, how are you today?
I'm good. How are you? Great presentation so far.
Yeah, Garrett's beaming into us, and he's going to close us out here. He's going to talk a little bit about the F&G product portfolio and specifically their rider that increases the income for their clients without having them to be confined to a facility, which, as I said before, no one wants to do anymore. So I think it's a key differentiator, especially for those clients that may or may not qualify or do not want to go through the underwriting process. So Garrett, take it away, and I'll be back to close it out today. And thank you very much for attending.
Awesome. Thank you. A little sad I didn't get called a Lamborghini or something other than a Ferrari or Shelby. But I'm going to close it out like a Lamborghini in my eyes. So today I'm going to go pretty quickly because we're short on time, but the Accelerator Plus series, it's one of my favorite series here at F&G. It covers all three really topics for a client that you see with a fixed index annuity, and those are the true value proposition. You're going to see the accumulation, the income, and then a solution to cover something for long-term care needs. That's really where I'm going to focus on. So at the beginning of this presentation, I'm going to kind of fly through the product details. Once we get to the illustration and what Dan was referencing, I'm going to spend a little bit more time. With this product here, the Accelerator Plus, it's a 10 and 14-year chassis. Your clients are going to have the option to select that chassis, and that's going to decide that bonus. So they're going to see up to a 7 to 8% premium bonus depending on that state variation and chassis selected. And one thing that I think is really important also to point out to F&G is our strong partnerships with Barclays, BlackRock, Goldman Sachs. So we have 3 vol control indexes on this product. We have the Barclays Trailblazer Sector 5, the CIBC Balanced Asset 5, and then the Goldman Sachs Global Index, which is a new index that we just launched that's global facing. So it includes US equities. And those are all guaranteed never to go below 100% participation rate. And I think that is a huge value added. From being in the annuity industry now for 10 years, that 100% participation rate is really going to put at ease a client's mind that we're not going to drop that down to a 20 or 30% participation rate. And another thing that I wanted to also point out before I transition over to the next slide is we have 3 riders or waiver riders built into this contract. They're built into all of our portfolio at F&G. I think that is a little unique from the industry itself, but we have the home health care, nursing home, and terminal illness. So if your clients qualify for one of those 3 riders, F&G will waive 100% of the surrender charges. They'll have access to 100% of the account value plus any gains earned. And then all of our products across our sweep has a 10% penalty-free withdrawal starting after year 1. And then when I say this standard death benefit on this contract, I'm going to show you on the illustration why it's not just so standard. It will beat out any enhanced death benefit almost in the marketplace. So the Accelerator Plus is driven by 2 options here on the income side. So you're either going to get 5%, guaranteed 5% compounding roll-up rate, or what we call here at F&G the performance multiplier. And that performance multiplier can be up to 150% of the account value. You get both of those for an annual fee of 1.15. And then down here at the bottom, this is kind of what Dan was referencing here, is the activities of daily living, grounded to an income base, including the impairment multiplier. So we call it an impairment multiplier. So if your clients qualify for that, if it's a single life payout, we will double their payment. Or if it's a joint life payout, we will 1.5 times that payment. And that is included in that rider fee of 1.15. And I'm going to go over that way more extensively on the illustration. So I'm trying to go through this pretty quickly. But I also wanted to point out that is approved in the state of California. So the illustration where I'm going to spend most of my time, this is where you guys are going to see the bread and butter of this product, everything at work for your clients. So I ran the Accelerator Plus 10, issue age 55, $250,000 in premium, and I allocated 100% into the balanced asset 10, 2-year point-to-point with the buy-up fee. Now, before I transition over to the next slide, you're probably going to ask yourself, what is that buy-up fee? So that buy-up fee, you pay a 1.25% fee, and it's paid over the duration of the index crediting strategy selected. So since this is a 2-year, it's 0.63% annually that the clients would pay in to get a higher participation rate. So the spot that I'm going to spend the most time on my presentation is this slide and then the next two. So I had to color coordinate it for you. Compliance wanted me to make it really pretty. So in the top green here, you're going to see that I put $250,000 in premium in. This client is 55 years old. We're going to defer taking income now for 10 years. If you look at that purple arrow, after 10 years of index crediting growth and the balanced asset 10 2-year point to point with the higher participation rates because we bought up that fee, your clients now have an account value of $799,000 and some change. So well over doubled their account value in 10 years. Now that long stretch box, you're going to see it there. I wish I could point to it, had a laser, but the first column there is that 50%. So that is that performance multiplier that I talked to you guys about. And the way that you're going to calculate that each year, because it grows at 5% each year, your clients defer taking income. So in year one, you're going to take year one account value, the $264,000, times the 1.05, and that's going to equal your income base. Now, if you look at year 10, you're going to take year 10 account value, that's that purple arrow, the $799,000, and you're going to take that times 1.5%. That is going to equal your income base in year 10 of $1,198,738. Because this client is 65 years old, they're at that 5% payout factor for us. So they're going to receive a guaranteed lifetime income payment of $59,937. They're going to receive that for the rest of their life. Now let's take a second to look at that last number in the box. That is what we call our impairment multiplier. So Dan talked about it a little bit. There's no confinement. They can stay in the comfort of their own home. In today's world, that is huge. Every call that I have comes in is can they stay in the comfort of their own home? Yes, it is strictly ADL driven. So as long as they're unable to complete 2 activities of daily living, it's signed off by a U.S. licensed physician and they're over the age of 60, they would qualify in this example for a double payment. So they're going to receive the $119,874. And some of you are probably asking, does that shut off after 5 years? Most of the industry doublers in the fixed index annuity space, they shut off after 5 years. Ours does not. Ours will continue to pay out that impairment multiplier until the account value reaches 0. Now take a second to look at the account value and that impairment multiplier. That is going to roughly last you, let's assume 0% interest crediting, 6.5 years. Now let's assume the lowest 10-year period over a 20-year look back of the balanced asset 10, which was 2003 to 2013. If you assume that 10-year growth continuing while you're taking that impairment multiplier, that's going to last them over 8.5 years. Now let's assume that you're getting the same returns that you've seen for the last 10 years on this, the most recent 10 years, a bullish market. That money could actually last them over 10 years. So they could continue to receive $119,874 for over 10 years. So once that account value reaches 0, we will then revert them back to receiving their guaranteed lifetime withdrawal payment of the $59,937 for the rest of their life. Just because the account value went to 0 after their impairment multiplier does not mean we will not pay them anymore. We just simply revert them back to their lifetime payment amount.
So Garrett, it's Dan. So what you're saying is the client drops in 250, 10 years go down, they need care. Based on the historical performance on this illustration and the factoring and the withdrawal percentage, they can pull out 119,000. And then the length of time at 0 after that, they can pull it out for 6 years. If it's the lowest historical last 10-year period, they could pull it out for hypothetically 8 years. And if we had a run like we've had the last 10 years, they could pull it out 10 plus. And then
Exactly.
worst case scenario is that the account value goes to zero. And at that point, it still reverts back to the 59,000 that lasts until they're on the other side of the grass, as I like to say.
That is exactly right. Yep.
You know, that's a pretty powerful story to tell your clients as far as how they can, you know, because in my mind, clients want to understand how they can use this $1 and get 3 different risks insured out of it. You know, ensure that I'm not going to run out of money because I have a lifetime income opportunity. Ensure that I won't lose money in the market due to a downturn in the market, only to any fee or rider that I pay to get an added benefit. And oh, by the way, I'd like to also use it if I get sick to get a boost on my income to pay for long-term care. So it's like being able to get 3 things for the same dollar. It's an amazing opportunity for our clients out there. And I would tell you, with the rise in interest rates and the caps going up, you know, these products have become super popular, and we're seeing inflows on these way up for fixed index annuities and riders. And we think it's a great solution for the clients. So I just wanted to jump in there and go through that, really how powerful that really can be for your clients and delivering them that Swiss Army knife type solution. Again, if they don't want to go through underwriting or they don't qualify, I mean, they're still getting tremendous value with something, you know, a product of this nature.
Yeah, exactly. Yeah. And that's why whenever I present on this product, I love to call it a true value proposition, because it's really focuses on accumulation first. The accumulation drives the income. The income base then drives their guaranteed lifetime payment amount. And then it drives their impairment multiplier. And then here down at the very bottom, look at that yellow box there. So they've taken out $600,000 out of this contract. This was a $250,000 contract 20 years ago. So they've taken out $100,000 over the doubled amount. Now look at that little square box right next to that yellow arrow. They still have an account value because they're still index crediting, strong index crediting because of our strong partnerships that we have here at F&G. They have an account value of $1,209,000. Now, if you shift clear over to the end, here's that true value proposition as well. They have a death benefit to leave to their beneficiaries of $1,209,311. So 20 years ago, let's recap. 20 years ago, they put in $250,000. They let it accumulate for 10 years. That drives the account value to roughly $800,000, an income base of $1,198,000, giving them a guaranteed lifetime income payment of $59,937. They're going to withdraw that amount for 10 years and take out $600,000 out of this contract and leave a beneficiary a death benefit if they were to pass away at age 75 of $1,209,311. Hits all 3 buckets: accumulation, income, legacy. Also, again, do not forget that impairment multiplier. That impairment multiplier is also in there. If any LTC needs come up and they need to have a higher payment, we will increase that to $119,000. And kind of on those numbers that I was referencing before. So I wanted to, and I was dead on the dates, which is great. I wanted to show you the lowest period, because you guys are seeing inflated, you know, participation rates and caps currently right now. I wanted to show you what it would have returned with the balanced asset 10 2-year point to point over the lowest 10-year period in a 20-year look back. So if you look at it from 2003 to 2013, have the housing crash in there of 07, 08. Their average annualized growth rate on the lowest 10-year period over a 20-year look back is 6.9%. And that is still a very strong return and a fixed indexed annuity. And then really what I wanted to focus on, and what Dan really keened in on as well, is this impairment multiplier. I'm going to take all credit for it. I did create this marketing piece for our marketing team. It simply just goes over the numbers that I gave you guys on the illustration, it shows that a client had $25,000 in guaranteed income payments from F&G. If they were unable to complete 2 activities of daily living that was signed off by a U.S. licensed physician over the age of 60, single life payout would be $50,000. Now, to also give you an idea of what it would be for a joint life payout for a husband and wife, 1.5 times, that would be $37,500. I listed the 6 activities of daily living. Key things to take away: no confinement, available in California, no 5-year limit. We will continue to pay it as long as there's an account value. And only qualifications is over the age of 60, contracts and enforced for at least 1 year, and they're unable to complete 2 activities of daily living. And then just another quick marketing piece. We have a ton of them out there on our website. I would encourage you guys to reach out to Dan and his team over at Alpine. Reach out to them, reach out to me. I'm more than happy to help you guys out any time of the day. But this is just another one of the marketing pieces that we have. Gives you guys kind of idea of where the bonus is, participation rates, and performance multiplier, and then also that really important feature on these products that we have on all of our fixed index annuities with an income rider, the impairment multiplier. So if the accelerator might not be a great fit, we have other products out there in our market or our portfolio that does also include the impairment multiplier, such as our new product that we just launched this year, the Safe Income Advantage, the guaranteed income play. And you have the option between a level income, a fixed increasing income at 3.5% each year, or an inflation-based index that's based on the CPIU that can increase your client's income by up to 5% each year. With that, I think I brought it home. I'm going to pass things back over to Dan, and if you guys have any questions.
Yeah, Garrett, listen, I didn't have anything left at the end. Ford versus Ferrari versus who? I didn't really have anybody, but you know what I would say? If anybody in the movie, you'd be Ken Miles, the driver who won the Le Mans. He was played by Christian Bale, and there's a slight resemblance there, Garrett. Maybe it's the chin. I don't know. Slight resemblance to Christian Bale and Ken Miles. So really, thank you for coming in today and talking about that solution. I really think that it really fits F&G and their portfolio, and I think they have a lot to offer our clients. And again, if you have any questions on any of these products, please feel free to call us here at Alpine Brokerage. You can give us a call at 866-777-2006. And well, that's it for today's presentation. I want to thank all of you for coming on. Don't forget, if you like the stream today, give us a like on Facebook and YouTube, or follow us on LinkedIn. Just go into the search bar there and hit Alpine Brokerage. And again, if you have any questions at all, contact us and your dedicated marketer here. We look forward to seeing you at our next presentation, and look forward to seeing you out in the field. And thank you all for your business. So have a great day, everyone. Thank you so much. Bye-bye.